Hello, LifeCraft community. It's Jose Martin, your friendly neighborhood certified financial planner professional and president of LifeCraft Wealth Management, here with a market update and the results of our second quarter investment analysis. The U.S. investment markets had a solid rebound following the big dip they took in April on the heels of what I'll describe as the Great Tariff Scare. Most stock indexes are now at or approaching all-time highs, which is quite a turnaround considering that as recently as 3 months ago, they were down anywhere from 10% to as much as 20% for the year. We remain cautiously optimistic that the second half of the year will show continued positive performance despite what are sometimes unsettling headlines. The bond market has been mostly steady if somewhat unspectacular, which frankly is what bonds and fixed income are supposed to do. Generally, they serve the role of stable growth in a traditional portfolio. Turning to the LifeCraft portfolio allocations, we feel great about the adjustments we made in our last quarterly review, and we have only minor tweaks to report for this quarter following our in-depth analysis. As a reminder, we build our client portfolios with 3 distinct sleeves: growth, low volatility, and a flexible sleeve. In our low volatility sleeve, we utilize the following 4 strategies in these respective allocations: 30% Spectrum low volatility, 30% Regan total return, 20% North Square preferred and income securities, and 20% Alpha Architect 1 to 3 month box. I'm happy to report that all 4 managers continue to show relative outperformance to their respective benchmarks and peers, and none are being removed. Adjacent to the low volatility sleeve, we retain a sub-sleeve dedicated strictly to alternative investments. Last quarter, we had shifted the allocation of this sleeve to the AQR diversifying strategy, which implements 6 alternative buckets within its single fund. True to its objective, it is showing only an 18% correlation to the S&P 500, helping to continue to limit volatility within client portfolios while offering healthy returns after expenses. Pivoting to the flexible sleeve, which in our portfolios allows our managers to shift between market investments, cash positions, or market inverse allocations, depending on the respective proprietary methodologies, we saw outperformance by 2 out of our 3 managers. We'll be retaining all managers in our flexible sleeve in their current allocations. Lastly, our growth sleeve, which includes AlphaV's focused growth strategy at 50%, AQR's long short strategy at 22.5%, and a blend of Pacer Cash Cow ETFs, also at 22.5%, tracked favorably relative to its benchmark. Within the AlphaV strategy, some of the individual securities that are being retained include Google, Amazon, Nvidia, Apple, and Meta, which is better known as Facebook. Stocks sold in the AlphaV strategy include Monster Beverage, ADP, and Boston Scientific, while adding companies like Uber, DoorDash, Palo Alto Networks, and my wife's personal favorite, TJX Companies, the holding company for TJ Maxx, Marshalls, and HomeGoods. In the Pacer Cash Cow series, holdings include ExxonMobil, Pfizer, Ford Motor Company, Fox Corporation, and Walt Disney Companies, which was recently added. On the flip side, Pacer has sold HCA Healthcare, Mastech, and Uber, which ironically I just indicated was added by our other strategist, AlphaV. While on the subject of the Pacer Cash Cow series, it has underperformed for the past rolling 1 and 3-year periods, which begs the question, why would we retain them in the portfolios? To answer, I'll dig a little deeper. Firstly, we have strong conviction in their methodology, which identifies companies with outsized free cash flow on their balance sheets, which they can in turn use to generate growth opportunities such as via dividends, stock buybacks, or to finance acquisitions. That said, we believe a methodology alone does not assure success, so it must continually demonstrate that it will deliver on its promises. To that end, we looked under the hood to see how it has performed cyclically. This sheet, which is publicly visible on Pacer ETF's website, www.paceretfs.com, demonstrates its preponderance of outperformance over rolling 1, 3, and 5-year periods. As such, we are exercising caution and continue to give them the benefit of the doubt given their historically strong performance, but do have them on our heightened alert. In fact, within their sleeve, we'll be allocating a portion to their respective international ETFs to help bolster our exposure to other markets and economies beyond the exposure that we currently have within the AQR long-short strategy. I hope you found this informative and useful. If you have any questions or thoughts, please don't hesitate to reach out. Otherwise, till we meet again, I wish you love, joy, health, and prosperity.